Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how to effectively use Creditor Tools, specifically loan covenants. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. Loan covenants are conditions that a borrower must comply with as specified in a loan agreement. Covenants involve reporting requirements, financial performance thresholds, affirmative and negative actions. If a debtor fails to adhere to the covenant requirement, it will result in there being a violation and a technical default on the subject loan, enabling the creditor to call a timeout, if you will. Its purpose is to enable the creditor a way to mitigate the increasing credit risk. It is common for creditors to formally altogether waive or temporarily forbear covenant violations for a variety of reasons. Doing so will not affect the remaining terms and conditions of the loan or for compliance to the upcoming covenant requirements. Take the time to read and understand all required loan covenants. Creditors usually install the appropriate covenants, like the right number of covenants and how often they are to be measured, as part of a solid loan structure. They just want to get repaid and are not out to sabotage a debtor. Else, why would they lend the money in the first place, right? And besides, debtors agreed with these terms in the loan agreement, or at least they signed the document whether they understood what they were signing. Few probably take the time to read and understand it like they should. That said, covenants protect the creditor's interest by requiring the debtor to achieve certain performance financial ratios or benchmarks and to also submit financial reporting on a regular basis, be it monthly, quarterly, annually, and so forth. Loan covenants serve various purposes. Performance ratios may involve metrics for debt service coverage, profitability, efficiency, leverage, and even liquidity. The creditor is seeking to preserve asset quality, like cash, accounts receivable, inventory, and maintain cash flow net worth, and control growth. Other purposes include ensuring proper financial disclosure and making sure management quality is maintained. Covenants will also protect the creditor by ensuring the business continues to operate. There are also affirmative covenants which require the debtor to do certain things. For example, they may include paying all payments when due, maintaining insurance, paying taxes, providing financial reporting, meeting minimum or maximum financial ratios, maintaining certain levels of working capital and net worth, following certain accounting procedures, permitting inspections, advising on litigation, and maintaining fixed assets. On the other hand, negative covenants will limit or prohibit the debtor from doing certain things. For example, the covenants may limit new debt, sale of assets, capital expenditures, lease payments, officer salaries, and dividends. Covenants can prohibit certain types of investments, loans to certain parties, mergers, acquisitions, and changes in management. For longer-term loans, all covenants will be fully described in a formal loan agreement and are binding. Alternatively, where there is no loan agreement, it may be more likely the loan has a short-term maturity with a balloon payment. This will allow management to make an appropriate review at maturity, which is pretty much what covenants do in long-term loans. Covenants that are not too tight or too loose. Creditors are expected to prepare appropriate covenants to not have them too tight or too liberal or with too much headroom before they trigger a default. If they are too restrictive, it will be more likely that the company will frequently trigger unwarranted violations. At the other extreme, if they're too trivial with too much headroom, the borrower might be insolvent before the financial covenant is triggered, which does nobody any good either. Again, covenant violations are serious and can result in the acceleration of the debt's maturity date or trigger the application of a default interest rate until the violation is cured. This short ad is sponsored by the Debt Crisis Problem podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. So why are loan covenants important to you? Study and understand what your loan covenants are. Read and understand what covenants you are committed to, whether they are based on credit metric performance or financial reporting, even the affirmative and negative actions. How much cushion is there in measuring up to your covenants? And what is the trend line looking like over the past year? Where will the trend go? And will there be future covenant violations based on the trend analysis? It's doubtful most debtors even read them all. But if you're in a serious economic downturn environment, they become increasingly more important. Covenant limits are more likely to be violated or triggered, and the fine print in the loan agreement could come back to bite you if you're not prepared. As noted earlier, covenant violations are serious business, and it's entirely possible that if not corrected, the creditor could demand payment in full in 10 days. The gloves could come off, and you may not have a clue what's happening before it's too late. So pull out the loan agreement, read it, research any questions, talk with legal counsel, whatever it takes until you really truly understand what it's saying regarding all the covenants. If you don't have a copy of your promissory note or loan agreement, ask for a new copy from the creditor. It's okay to ask the creditor what the loan covenants mean and how they're calculated and so on, if you need to. Not everyone is conversant with such covenants. No question is a dumb question. After all, if you have loans outstanding, you're already in bed, if you would, with the creditor, so you may as well get to know what it is that you've got yourself into, if necessary. Pay extra close attention to the financial reporting or performance covenants. Assuming you are compliant with the reporting requirements, like you submitting all your financial statements or certifications and that stuff on time, focus your attention on the ratio requirements in the performance covenants. As poor economic conditions play out, it is likely you will trigger a violation for not performing as agreed. Based on the new normal of trends, does that mean the covenants themselves need to be adjusted higher or lower so as to not trigger more violations that everyone can see will be coming? Maybe. If the covenants become unreasonable, then maybe it's time to have them adjusted so that violations don't happen, assuming the lender wants to continue the relationship. But perhaps the covenant metrics are appropriate and still attainable. You and the lender both agree that you can should and will quickly perform to the existing covenant expectations in the near term. If that's the case, the creditor will recognize such violations, but just issue a waiver letter for any specific violation. He will wait to see what happens the next quarter, for example, when the covenants are tested again. If the creditor doesn't like what's happening, he may temporarily forbear, not waive, the violation for a short period and remeasure the results to determine if a default has occurred. Make your voice heard when it comes to loan structure and covenants. Creditors need to be realistic and recognize that your financial condition has, in fact, deteriorated, and that will affect your covenants accordingly. So for you, it is important to understand the covenants, what they are, what they mean, and how they're measured. It tells you how much headroom you have to operate before a violation is triggered. You need to speak up if they're too restrictive and have a say in the negotiations. It is your business. How can you possibly sign a loan agreement and essentially enter into covenants if you don't agree with them or understand them in the first place? Remember, creditors didn't have to lend the money at origination or when there's a covenant violation. A condition of default could easily lead to a demand for payment in full. But that doesn't mean you shouldn't have a clear understanding of what they are and have a voice in how covenants are structured in the loan agreement each time you sign one. Thank you for joining us. Today, we covered the Creditor Tool loan covenants as debtors prepare to propose their own repayment solutions. And we want to hear from you. Share your own credit risk memo and debt repayment experiences, your inputs, questions, recommendations with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.